All right, let's dive right into this explainer on the 2026 inflation crisis and exactly why that recent raise of yours might feel like it just completely vanished into thin air. Seriously, if you've been looking at your bank account lately and feeling like you're running on a treadmill, making more money on paper but not actually getting anywhere, you are absolutely not alone.
Quick heads up before we get into the hard data and the specific strategies. Everything we're discussing today is strictly for educational purposes, not financial advice. The economy moves fast, so always check in with a licensed professional before making any major financial decisions.
So here's the reality a lot of us are facing right now. Take Sarah, a dental hygienist in Columbus. Back in January, she got a fantastic 4% raise. It was her biggest bump in 3 years. And for about 6 weeks, she actually felt ahead, right? Her budget finally had a little breathing room. But then, well, her electricity bill arrived, she filled up her gas tank, and her usual grocery run suddenly rang up at $340 instead of $290. Because inflation hit 4.2% in May, Sarah's 4% raise didn't actually make her richer. It basically just made her slightly less poor for a few weeks, until inflation caught right back up.
Here is how we are going to break things down in today's explainer. 1. The real wage gap. 2. Triggers of the 2026 crisis. 3. Where prices still hurt. 4. 6 moves to protect wealth. And 5. The Fed's impossible position.
Section 1. The real wage gap. Why you feel behind.
If you feel like you just can't get ahead right now, you aren't imagining things. It is pure math. Let's make this incredibly concrete. Say you earned $60,000 in May of 2025 and got an average 3.7% raise. Awesome, you're making $62,220 a year later. Sounds great on the surface. But with May's 4.2% inflation rate, you actually needed to earn $62,520 just to maintain your exact same purchasing power. You are literally $300 short for the year, purely because of the gap between your wage growth and inflation.
So the real kicker here is that real wages, meaning what your paycheck is actually worth out in the real world, fell nearly 0.7% year over year in May. The typical worker is actually losing ground, even with a bigger paycheck. In fact, pretty much all the purchasing power gains we made over the prior 13 months completely wiped out. We've effectively been sent right back to January 2025 levels.
Section 2. Triggers of the 2026 crisis. The anatomy of a spike.
Now that 4.2% inflation spike we saw in May wasn't just some random economic blip. It was driven by two very specific things. First, we had a weird statistical artifact. During the October 2025 government shutdown, rent inflation couldn't be properly collected. So when data collection finally caught up in April, boom, 6 months of rent increases hit the metrics all at once. It created a massive artificial spike in shelter data. But the second trigger? That was very real. The February 2026 U.S.-Iran conflict severely disrupted Middle Eastern oil supplies, which shocked global energy markets. A June ceasefire definitely helped cool inflation back down to 3.5%, but the damage to those main numbers was already baked in.
To put that energy shock into real dollars, gas didn't just inch up, it spiked 28.4% year over year. For a typical driver, that is an extra $684 a year going straight into the gas tank that simply wasn't in the budget 12 months ago. And you have to remember, energy costs have a massive ripple effect. Higher gas means higher transportation costs, which pulls up the price of literally everything shipped to your local store.
Section 3. Where prices still hurt. The sticky categories.
So even though headline inflation dropped to 3.5% in June thanks to the ceasefire, we still have these sticky categories actively squeezing our budgets. Look, a 3.2% increase on groceries might not sound world-ending by itself, but remember, this compounds on top of the 20 to 25% cumulative increase we've already seen since 2020. Meat, dairy, and produce are getting hit the hardest. Meanwhile, shelter remains super painful. Even if new lease prices are stabilizing in some cities, existing leases are still playing catch-up to past market rates. And then, medical care costs are compounding at 3 to 4% annually. That's tough, because you can't exactly substitute a cheaper store brand of heart medication like you can with a box of cereal, right?
And then there's insurance. This is the silent budget killer, guys. Auto and home insurance have been getting slammed with consecutive 10 to 15% annual hikes. So a family that was paying $4,000 3 years ago could easily be shelling out $5,500 today. That is a massive 37.5% cumulative hit. It often flies right under the radar of the big headline CPI numbers, but it absolutely wrecks household cash flow.
Section 4. 6 moves to protect wealth. Actionable steps.
Okay, let's pivot away from the macro data and get into the micro solutions. Here are 6 precision moves you can make to actually protect your money. Move number 1 is arguably the most critical. You have to negotiate a raise that beats inflation. It's that simple. If CPI is 3.5% and your raise is 3%, you took a real pay cut. You need to bring this actual inflation data directly into your next salary negotiation to defend your purchasing power.
Now, look at move number 4 regarding your cash. This is a real game changer. With inflation sitting at 3.5%, leaving your emergency fund in a traditional savings account earning 0.38% is quite literally a guaranteed loss of wealth. But if you move that money to a top high-yield savings account paying around 4%, your cash is finally producing a positive real return for the first time in over 2 years.
And running through the rest of our list, small swaps really do yield big results. Switching to store brands on your usual groceries can effortlessly save you about $450 a year. Moving to move 3, fixed costs, especially fixed-rate mortgages, act as the single most powerful inflation hedge available to everyday households because your payment stays flat while everything else goes up. Finally, do a quick audit of those hidden variable expenses, like forgotten streaming subscriptions, and above all, keep investing in broad market index funds. Historically, they outpace inflation over the long run, totally regardless of what today's headlines say.
Section 5. The Fed's impossible position. What happens next?
To really understand what to expect for the rest of 2026, we have to look at the Federal Reserve's incredibly tricky position. The core issue? We're dealing with energy-driven inflation. The Fed's main tool to fight inflation is raising domestic interest rates. But here's the problem. Higher borrowing costs for U.S. consumers do absolutely nothing to lower global oil prices, and they definitely don't resolve international conflicts. So the Fed is stuck. They're watching geopolitical supply shocks spike prices, completely unable to fix the root cause, all while having to keep borrowing expensive for everyday people.
Mark Zandi, the chief economist at Moody's, summed it up perfectly. And honestly, this isn't meant to be doom and gloom at all. It's just a realistic assessment. The cumulative price hikes from 2020, they are here to stay. The affordability crisis didn't just vanish because inflation ticked down a fraction of a percent in June. Deliberate budget adjustments on your end are absolutely essential right now because things just aren't going to magically get cheaper.
The math is clearly working against the average earner right now, so I really want to hear from you. Which inflation category is squeezing your household the absolute most? Is it the grocery store? Is it your insurance premiums jumping up? Or is it something else entirely?
Drop your answers down in the comments below. We love reading through them. And please be sure to hit that like button, share this with a friend, and subscribe so you don't miss our Tuesday Explainer, where we are going to dive into a specific framework to actually reduce financial anxiety, something I think we could all use a little bit of right now. Stay smart with your money, and I will see you on Tuesday.